Hey everyone, it's Tom Kratz. I'm in the center in this circle here. Listen, this is coming up a lot. A bunch of people have picked up that we are mentioning income is going to be really important over the next 10 years as a real estate investor. And income is always important. It's why we talk about cash flow all the time. But I want to explain why income is going to be critical to survive the next decade in real estate. So let me see if I can shove myself in the corner here. There we go. If I go to historical, we're going to look at TREB data really quickly, and then we're going to look at some US data. We're going to look at some data from Argentina really quickly, and then I have a little homemade graph that you're going to laugh at here. But if I go to historical stats here in the Toronto real estate market, and if you look at these historical stats, you can Google these up yourself. You can look at this chart here, and actually the data right here is really handy to look at. You can see in 1990, prices started coming down. In 1989, they moved up rather quickly in the late 80s. 1990, they started coming down, and then they went down for 6 years. So they kept kind of going down in a bit of a bumpy path. They moved up a little bit in 94, but then they kind of bottomed out completely in 1996 before they started going up again. And then you can see in 1997 they went up, and then in 1998 over here you can see they went up further. But there was a 6-year little window here where prices really just were kind of kept going down. And a lot of that, if you didn't live through that era, a lot of that was sellers thought things were going to get worse. So even if they had not sold in 91 or 92, by the time 93 hit, they were like, oh my gosh, I better sell. Prices are just going to go down further. So there was a lot of just this kind of momentum building up on the downside, and people were kind of selling. And it all started because interest rates were cranked up around 1990 by the Bank of Canada and then the commercial banks here, and that just like flattened and hammered the real estate market. So you had a 6-year window here that we lived through as our family was flipping real estate, that if you didn't have income, if you didn't have cash flow, and you were solely depending on appreciation or lines of credit in today's world to tap into some of your equity, that equity can vanish on you. It can completely vanish. So if you don't have some cash flow, which we did not, it is very, very difficult times for you and your family. That's why when everyone's buying, not everybody, but when a lot of people are buying for appreciation only, and they're not concerned about the income component of their real estate portfolio, they don't understand that you can have multiple years of a downswing in real estate prices that you need to survive through. And if I switch over to some US data, here's the St. Louis Federal Reserve. So you can Google this up. You can Google up St. Louis Federal Reserve median sales prices of houses sold, and you can get this data. And if you look in 2007, things really kind of peaked in the US. And then if you look, the median sales price, things kind of were on a downward trajectory for, what is that? A couple years here, so like 2 years, and then they started inching up. And the only reason they inched up rather quickly as compared to the Canadian example that I just showed you is all the quantitative easing and money that was like shoved into the economy. And some markets went down for longer, right? There was different pockets of the US, and you can Google it all up and get that data. But overall, you can see the US on a whole, it came down for a couple of years, then it started inching up, it came down a little bit, and then it took, to get back to where it was looks like a full 5 or 6 year swing here. But so this is a much less time period here. But if you don't have income during this period and you're solely depending on your equity and constantly tapping equity in your real estate to survive, that can vanish on you in a flash. And that's why we believe you need income or you need cash flow to carry your properties, because even if your properties aren't going to pay for your life, at least let them pay for themselves by paying for themselves at a break-even pace or producing some cash flow. And we were recently talking to a rock star investor from Argentina who's up here doing really well for himself up here in Canada. But he shared with us how in Argentina, things went haywire. And I don't know if he was talking about this time frame or not. Let me see if I can switch over to this chart. Here's a chart of property prices in Argentina. And this is interesting, because in Argentina, if you haven't heard, Argentina always seems to have a currency crisis where the currency is being devalued and there's some credit problems. But if you look at prices here from 2005, and this is a US dollar per square foot measurement here. If you look at prices from 2005, they went from this, I'm trying to see when they doubled. It looks like this is maybe 750. So they went from $750 a square foot to 1,500. So they doubled in this kind of time period. And it's during this time period. And then they almost, they went up another chunk here. And this is the time period where everybody thinks they're getting rich. Like everybody's like, oh my gosh, real estate does so well, and just hold on to some properties. But then this happens, and this is a huge blow. And if you were over leveraged during these times, and if you have no cash flow, it's tough to survive these events. And you can see it went through a few year period from 2013 to 2014, and then flat into 2015, where things are flat. And then the central bankers come along and shove more money into the economy, and things go rip-roaring ahead again. So really, when you understand this dynamic, and you understand that there's a lot of debt in the world, so the central bankers are going to have to shove a lot of money into the world if anything like this happens here in North America, we can kind of expect, we kind of know what to expect, I guess is what I'm saying. But I'm not sure everybody's planning for this. We lived through it as a family, so we definitely want to share it. And now I'm going to show you the most brutal chart you've ever seen in your life, but I want to explain something here. I made this especially for this video, so don't blast me for this, but here's what I want to explain. In this part of this chart, this is real estate prices going up. And when real estate prices are going up, if we're in this phase of this era here, everybody feels good, like, oh my gosh, real estate prices go up, you can do no wrong, let's buy some real estate. But then if there's a credit event, if the banks stop lending, which is what happened in the US to really crash real estate prices. In Canada in the 1990s, it was more an interest rate increase that made it difficult to qualify. But if banks stop lending, the real estate market can come to a halt. And I've kind of exaggerated this to just show you what I mean, but any equity that you think you might have could vanish. And then we're going to go through a time period here where I don't know if it's going to be 6 months, 12 months, or 18 months until the central banks push money in a massive way into the economy. And the reason that I feel they would, and this is just our opinion, is that they cannot let this happen for any length of time because there's enough debt in the world that if the real estate market was to come crashing down and stay down, it would collapse the whole system. Because there would be this contagion effect that would spread right through the system. And if you followed Greg Foss, a guest of ours on the podcast multiple times now, and you can follow him on Twitter, he's a 30-year veteran of the bond markets. He talks about contagion in the credit markets all the time. And if there is some contagion in the credit markets and things just halt, real estate prices will come down. And it's this period of time that we need to survive, because I believe my money is on the central bankers then just pushing so much money into the system that they will eventually, real estate prices and hard assets will shoot back up and maybe go past where they were before, and then continue their trajectory forward, rightly or wrongly. And I have no idea if that has lasting power or not, but I do know I do want to own hard assets. I do want to have access to liquid funds in economic times like this. And liquid funds to us are not just credit lines that you have access to, because if an event like this happens where property prices dip because of a credit event, you're not going to get access to your credit line. So when I say liquid funds, I mean like cash in the bank. Maybe it's you have some Bitcoin. If you don't like Bitcoin, maybe you have some gold, but have some monetary value outside of the banking system in some capacity, because if this ever happens, it could be devastating. And look, someone listening to this might think we're just like worst case scenario people. We're not. The upside will take care of itself. If we buy good hard assets, the quality of our lives over the next 10 years is going to mirror the quality of our assets. So we believe you need good hard assets in your life. And if you're involved in real estate, we just want to call out that there could be a period like this that you need to survive. And it's the income component of your portfolio that's going to be more valuable than anything else, definitely more than the price of the property. So just keep that in mind. That's why we talk about income being valuable. You want your properties to at least pay for themselves, ideally create positive cash flow. You don't want to be like us and our family in the early 1990s when we had real estate that was negative cash flow. In a deep recession, when you can't get jobs and you have real estate that you're feeding every month, that is a recipe for disaster. So just keep that stuff in mind. We just want to call this stuff out so that you're aware of some of our thinking, rightly or wrongly. If you agree or disagree, that's fine, of course. We just want to share some of our thoughts in case they're useful and get you thinking. That's it for this week. Till next time, your life, your terms.